Good day, everyone. I'm Anna Wichman of Capital Link, and welcome to Capital Link's Analyst podcast series, which provides analyst insights on a variety of topics relevant to the shipping industry. We are joined today by Angelica Kemene, Head of Market Analysis and Decarbonization Strategies at Optima Shipping Services. The company provides a wide range of services, including shipbroking, new buildings, repairs, finance, research, and consulting. Optima has offices in Athens, Dubai, Shanghai, Singapore, and Istanbul. Today, Angelica will give us an update of recent trends and the outlook of the dry bulk and tanker markets. And with that, I turn the floor over to you, Angelica.
Hi, everybody. I'm very pleased to be here with you. We'll start the presentation. I'll start by sharing my screen. And right now, I think you can just see the front page of our presentation. So good morning again. Good afternoon, everyone. Today, I will be discussing the current state of the dry bulk and tanker markets, focusing on both asset values and market dynamics, as well as providing insights into the supply and demand factors influencing the sectors for the rest of 2024 and 2025. So let's begin by looking at current market conditions. And on the left chart, we examine year-to-date time charter average growth for the past 10-year average. So for the tanker segment, product tankers saw the highest year-to-date growth in freight earnings compared to their 10-year averages, with LR1 leading, followed then by LR2s and MRs. Among the crude oil tankers, Aframax had the largest growth at 68% mark, followed by Suezmaxes and VLCCs. Regarding the bulk segment, Capesize earnings stands out with a significant 54% growth compared to its 10-year average. The Handy, Super, and Panamax just lag behind, with moderate growth in earnings at 23%, 30%, and 19% respectively. On the right chart, we plotted the year-to-date 10-years-old asset price growth to the 10-year average price of vessels aged at 10 years old. So tanker and bulk carrier assets are seeing strong price growth, especially older vessels like the Aframax, the MR, and the Suezmax. Notably, the Capesize has grown 68% in price, and Ultramaxes by 75%. New building price increases are at the range of 25 to 35%, which is more modest compared to the growth in price of older tonnage. Overall, the tanker segment, especially in older vessels, is seeing more significant asset price growth compared to the bulk segment, while in terms of time charter growth, product tankers and Capesize bulkers are performing strongly. Overall, second-hand asset values are trading higher than new building prices, but on the flip side, second-hand dry bulk prices have recently declined by 8 to 10%, especially for older vessels aged between 10 and 15 years old. So asset prices overall remain elevated. Interestingly, this doesn't fully align with the trends in the dry bulk freight market. The dry bulk sector is showing strong activity compared to the tanker market, and the S&P activity in bulk carriers has surged around 70% year on year, representing an estimated investment value of close to $9.5 billion. However, the contracting of bulk carriers in 2024 has been more subdued. And on the tanker side, we see new building orders firming. So these deliveries will increase from 2026, especially in the crude sector. And despite seasonal weaknesses like reduced Chinese crude imports and softer Russian product exports, the tanker markets remains resilient. Looking ahead, the dry bulk market is expected to stay healthy for the rest of 2024 and into 2025, driven by demand growth in the Atlantic and disruptions in key areas like the Red Sea. The tanker outlook also remains positive, supported by vessel rerouting around the Cape of Good Hope, changing trade patterns between Russia and Europe, and limited fleet growth. However, we must be mindful that the OPEC Plus output cuts delay could potentially cap the tanker market's upside as we head into Q4 2024. Now, shifting to the demand side and the global macroeconomics, global growth has been flatlining, and that is set to continue in 2025 with world GDP growth bases the Oxford Economics forecasts at 2.7%. In general terms, fears of a US recession are unfounded, with growth returning to trend, and neither the presidential elections nor geopolitical issues are expected to significantly impact 2020-25's global economic growth. However, China is likely to face challenges, while global growth is expected to stay below 3%. Turning into the China factor, we will look now at China's fiscal policy. Just a quick note here that even though Chinese bulker demand was not a problem for 2024, especially with those long-haul trades, the new and the past stimuli are very supportive for demand in the dry bulk carrier sector. So China's fiscal policy is moving in the right direction, with infrastructure investment accelerating due to strong governmental support. China announced in March and launched in May the introduction of ultra-long stimulus bonds aiming to drive investment in strategically important infrastructure, with likely another 1 trillion yuan bond issuance in the pipeline after the very recent triptych stimulus package aimed at spurring consumer spending to counter persistent deflation. At the same time, fixed asset investment in 2024 is gaining ground, and expectations are for an annual investment growth between 6 to 8% from the previous 10%, since new industries are not large enough to offset the drag from the property sector. The next slide provides insights into the dry bulk seaborne trade growth for 2024 and 2025, segmented by commodity and vessel type. And what we see is that the commodities growth forecast for 2024 is that iron ore is actually expected to grow by 5% in 2024, showing a substantial contribution to the total dry bulk trade, while coal, both thermal and coking, will show a modest growth forecast of around 1%, while grains will show a stronger growth rate of 6%, and minor bulks a growth rate of 4%, with an evenly distributed transport mix between Capesize, Panamaxes, Supramaxes, and Handysize vessels. While the 2025 outlook holds a mixed growth forecast, with iron ore projected to flatten and coal imports to slightly decrease by 1% in 2025. Grains and minor bulks are expected to continue moderate growth at 2% and 4% respectively, and so all of the above give us some 4% ton-mile growth for 2024 and around 2% ton-mile growth in 2025. Now we will look into the two commodities that actually supported this year the dry bulk market, and we will start by looking into bauxite trade dynamics. This year, Guinea has exported around 97.5 million tons of bauxite, while Australia has exported a third of what Guinea has done. Of course, the key destination is China to support China's huge demand for bauxite, fueled by actually its vast aluminum production capabilities, infrastructural needs, and growing industrial output, along with great technology advancements, given that Beijing has prioritized future-facing sectors on the economy, such as renewable technologies and electric vehicles, which has boosted demand for both copper and aluminum. The graph on the left tracks the monthly voyage counts of bauxite shipments for the two major exporting countries, which is Guinea and Australia. There is a visible increase in monthly voyages over time, especially in 2023 and 2024, with peak volumes occurring around the second quarter of 2024. Guinea's share in total voyages appears to have grown over time, consistently outpacing Australia by volume. So the ton-mile chart on the right demonstrates the distance-weighted volume of bauxite trade, and there has been a steady rise in ton miles from January 22 through 2024, with peaks around mid-2023 and early 2024 and now. The year-on-year increase in ton miles underscores the expansion of long-haul trades, supporting the bauxite shipping industry, especially in the Capesize sector, which handles these large bulk volumes. Global seaborne iron ore trade has shown strong growth in 2024, increasing by 4.5% year-on-year in ton-mile terms, primarily due to robust Chinese demand. Overall growth for the year is expected to stand at close to 5% year-on-year in ton-mile terms. And looking ahead, we would expect iron ore trade to flatten in 2025 if Chinese demand weakens, although multiple outcomes are possible. Chinese seaborne iron ore imports are on track to rise by 4% in 2024, driven by stable steel demand and favorable seaborne prices, leading to stockpiling. Australian iron ore exports remain steady year-on-year from January to August, with limited production growth. However, the ramp-up of mineral resources Onslow iron ore mine could boost exports in late 2024, with overall exports expected to reach close to 900 million tons. In contrast, Brazilian iron ore exports are projected to grow by around 8% this year, reaching a new high of over 400 million tons, supported by strong production from Vale's project like Vargem Grande. From January to August, Brazilian exports grew by 6% year-on-year, with exports to China actually rising by 12% year-on-year. Just a note here again about Rio Tinto's Simandou project, which will provide high-quality iron ore suitable for cleaner steel production, and which aligns with the push to decarbonize steelmaking, especially in China. So as global demand shifts toward high-quality iron ore of a ferrous content around 65%, shipping patterns may change, with routes focusing more on Guinea, Brazil, and Australia. Now we will turning now into the oil tanker seaborne trade growth. The outlook for the crude tanker market is generally positive, with signs of seasonal strengthening in September and a forecast for continued growth in 2025. Crude tanker trade growth is expected to rise by 3% next year, supported by the unwinding of OPEC plus cuts, starting maybe this December 2024. This follows a modest 2% growth projected for 2024, impacted by the weaker Chinese demand. But despite risks such as ongoing Chinese import challenges and disruptions in Libya, strong growth in long-haul Atlantic-Asia trade and limited fleet supply growth we do see that they provide support. In the product tanker market, conditions remain relatively strong despite some recent easing. However, demand is bolstered by rerouting through the Red Sea, leading to a 5.2% projected increase in product tanker demand for 2024. The market benefits from rising refinery capacity and longer haul seas in Russian flows. Looking ahead to 2025, product tanker demand growth may increase with an estimated increase of or close to 4%, assuming disruptions at the Red Sea persist. In general, global oil demand disappoints as China has been the principal point of weakness in global markets and lackluster activity in industrial and construction markets that have impacted somehow the oil demand. In the US too, gasoline inventories, a key measure of oil demand, are above their long-run seasonal levels, while demand for vehicle fuel in the developed countries will see a long-term decline as consumers transition to electric vehicles. Overall, while global oil demand is projected to grow, the rate of growth is expected to decelerate, reflecting broader changes in the energy landscape and regional dynamics. The overall global oil demand growth appears to be slowing down, as illustrated by the declining trend in the medium-term oil demand chart. And this could be influenced by various factors, including shifts towards alternative energy sources, efficiency improvements, and the economic uncertainties. The chart also highlights specific contributions from different regions, such as China and India and the other areas. While India shows a consistent demand trajectory, China's oil demand is projected to plateau or even decline slightly just in the coming years. The right side of the slide breaks down demand growth by product type. Products like gasoline and gas oil diesel are still expected to see reasonable growth, while others such as naphtha and ethane LPG may have varying levels of demand. And now we will look into the current landscape of the refining industry, particularly in terms of refinery runs and demand. Since 2021, we have observed an average closure of 500,000 barrels per day annually in the refining sector, with the majority of these closures occurring in the United States and Europe. However, it is important to note that these closures have been counterbalanced by significant expansions in refineries located in the Middle East, China, Asia Pacific, and Africa. As a result, we are ensuring that the global product supply remains in surplus. According to Rystad Energy, global refining runs are projected to grow by 1% million barrels per day this year, followed then by a 1.3 increase next year. And despite this positive outlook, Europe is actually facing a challenging scenario with the increased refinery closures, while the United States, in the United States, the refinery utilization remains steady at approximately 91 to 92%. Meanwhile, the Middle East is witnessing a consistent rise in refinery runs, bolstered by new projects in Iraq. In Asia and China, there is an increasing demand for sour and medium sulfur crude, and China's refinery runs are expected to surge later this year with the commencement of several new facilities. However, as we look ahead, we must also acknowledge the key challenges that lie before us. That is shifting geopolitics, evolving crude supply dynamics, carbon policies, and the fluctuating product markets that all of the above just pose significant hurdles for the refining industry. Now turning into the supply side, the dry bulk carrier fleet speed has been declining, as it can be depicted by the recent 3-year trend. 2024 registered even lower speed dynamics that can be attributed to environmental regulations, a trend that is actually expected to continue, contributing to a slight reduction in effective supply. This slide presents critical insights into the fleet age profile and order book composition within the dry bulk segment. The left side of the slide illustrates the age distribution of the fleet across various segments. Notably, 25% of the fleet is aged 25 years old or older, indicating a significant portion of older vessels, while the order book to the 15 years old plus fleet stands at 44%. So this relatively high ratio could be a response to stricter environmental regulations, which may push ship owners to replace older, less fuel-efficient vessels with new eco-friendly ships. And this 44% ratio for dry bulk carriers can also reflect a high level of investment in new capacity, suggesting expectations of robust demand or a need to replace aging vessels. However, it also signals the risk of oversupply if older ships are not scrapped in a timely manner. The right side of the slide provides an overview of the current order book, highlighting the expected deliveries of new vessels between 2024 and 2028. The aging fleet, combined with the current order book composition and the tightening environmental regulations, suggest potential supply constraints in the coming years. The concern lies in the economics of actually operating older vessels. Regulations are becoming stricter, and the cost-benefit analysis of retrofitting older ships with expensive energy efficiency technology may not justify holding onto them for much longer. From an investment standpoint, focusing on implementing a solid set of energy efficiency technologies on newer vessels, alongside operational measures like reduced speeds, appears to be the most viable strategy to meet 2030 emission targets, though from an investment point again, such a move may not be validated for vessels older than 10 years old. As far as the oil tanker supply is concerned, the average speed of the 2024 fleet is greater compared to that of 2023. And this increase in speed is greatly attributed to the ongoing tanker market strength. Given that the anticipated increase in scrapping activity did not materialize just yet due to favorable market conditions, we would expect the increase to start from 2026 and continue into 2027 and beyond. Emission regulations are projected to exert additional control over the active tanker supply with diverse scenarios. The supply side conditions for tankers remain favorable, with fleet growth expected to be relatively manageable in the near term, projected to rise for the crude tankers to a moderate 1% next year, though there may be more substantial expansion in the product sector at 4%. Here, 24% of the crude fleet is 15 years and above, and this number is 35% for the product tankers. New building activity for tankers has strengthened in 2024, with close to 350 units totaling around 40 million deadweight tons ordered this year. marking actually a 9-year high in capacity. However, due to long lead times at new building yards, significant delivery increases may not occur until 2026 and beyond, particularly in the crude sector. Overall, the market is expected to remain broadly positive as we move into 2025. And actually, this is the end of this presentation, and I really hope you enjoyed listening or watching it. Thank you very much.
Thank you, Angelica, for the presentation and for your insights. And thank you, everyone, for tuning in. Please look out for upcoming episodes in the Analyst podcast series, which will shed light on critical aspects of shipping. As a reminder, this podcast is for educational and informational purposes only and does not constitute investment advice or advice of any kind. Thank you.